Hey there, and welcome. So, you're gearing up for your big insurance licensing exam? Well, you are in exactly the right place. We're going to break down the absolute essential products you have to know, life insurance and annuities, and turn this into a super clear, focused study session.
Look, I get it. This stuff can feel pretty complex, a little overwhelming even. But don't you worry. This whole session is designed to give you the clarity and, more importantly, the confidence you need to walk in and absolutely ace that exam. Okay? Let's do this.
So here's our game plan. We're going to kick things off with permanent life insurance, then we'll see how it stacks up against term life. After that, we'll switch gears completely and talk about annuities, then touch on combination plans, and we'll wrap it all up with a rapid-fire review of the key distinctions you'll definitely need for the test.
All right, first up, permanent life insurance. You know, the name kind of gives it away. These policies are built for the long haul. They're designed to provide coverage for an insured person's entire life, just as long as those premiums get paid.
The absolute foundation, the granddaddy of all permanent policies, is ordinary whole life. Just think of this as your classic baseline model. It's got three main parts you have to remember: coverage that lasts a lifetime, payments that never change, and a built-in savings account called cash value.
Now let's zoom in on the guarantees, because these are huge selling points and, you guessed it, for sure going to be on your exam. The premiums are level, meaning they are locked in and never go up. The death benefit is guaranteed, no surprises there, it's a fixed amount. And of course, the coverage is for life.
But beyond those guarantees, whole life has this really interesting growth side. It builds up that cash value, which is what we call a living benefit, because you can actually use it while you're still alive. And the best part? It grows tax-deferred, and you can even borrow money from it, usually without even a credit check. Okay, I want you to pause and really focus on this slide. This is absolutely crucial for your exam. It breaks down how different permanent policies handle that cash value. With whole life, you've got a guaranteed rate. It's safe. The insurance company takes all the risk. With variable life, your cash value is invested in sub-accounts, kind of like mutual funds. So the policyholder takes on the market risk, but for the chance at much higher returns. In indexed life, that's your middle-of-the-road option. Its growth is linked to a market index, like the S&P 500, but it has caps that limit your upside and floors that prevent you from losing money. And don't forget another major player, universal life. Its key feature is flexibility with premiums and death benefits. We'll hit that again in the final review.
All right, let's shift gears now and look at the main alternative: term life insurance. If permanent is for your whole life, term is for a specific term, a set period of time. Its primary job is just pure temporary protection. So here's the core trade-off, and this is so important to understand. Permanent life lasts forever and it builds that valuable cash value, but it comes with higher premiums. Term life, on the other hand, is way more affordable because it only covers you for a specific window, like 20 or 30 years, and it has zero savings component. It is pure, unadulterated insurance. For the exam, you'll want to be able to recognize these four main flavors of term. Level term is the most common, everything just stays the same. Decreasing term is usually designed to cover a debt that's getting smaller over time, like a mortgage. And then renewable and convertible policies, well, they give you flexibility to either continue or change your coverage later on, typically without needing a new medical exam. And this is a perfect real-world example of how decreasing term works. So let's say you get a $300,000 mortgage for a new house. You'd buy a policy with a $300,000 death benefit. Then, as you pay that mortgage down year after year, the death benefit shrinks right alongside your loan balance. It's tailor-made to cover a specific debt that's disappearing over time.
Now here's a pretty unique one: return of premium term. And honestly, it's exactly what it sounds like. If you're still around when the policy term ends, you get all your money back. Pretty neat, huh? So what's the catch? Well, the premiums are going to be a lot higher than a standard term policy. You're basically paying extra for that money-back guarantee.
All right, time for a big pivot. We're moving from products that pay out when somebody passes away to products that are designed to pay you while you're alive. We're talking about annuities, and their number one goal is to create a guaranteed stream of income, most often for retirement.
So at its heart, an annuity is really just a contract you make with an insurance company. You give them your money, either a big chunk all at once or in smaller payments over time, and in exchange, they promise to pay you a steady income. It's basically a way for you to create your own personal pension plan.
The first big difference you need to know for annuities is when the payments start. With an immediate annuity, you give them a lump sum of cash and boom, you start getting checks almost right away. With a deferred annuity, you pay into it over time during what's called an accumulation period, and then the income starts flowing at some future date that you pick.
The second key distinction is how your money grows. A fixed annuity gives you a guaranteed interest rate. It's safe, it's predictable, the insurance company takes on all the risk. A variable annuity, on the other hand, lets you invest in market subaccounts. It offers much higher growth potential, but it also puts all the market risk squarely on your shoulders as the annuitant.
And hey, just like with life insurance, there's a hybrid option here too. An indexed annuity ties your returns to a market index, but it comes with a floor, usually 0%, which means you can't actually lose your principal if the market tanks. It really tries to blend that safety with some growth potential.
Okay, moving on to a more specialized category, policies that are designed to cover more than one person under a single contract. You'll often see these used by couples, either for income replacement or for estate planning.
Now you really need to pay close attention here because this is a super common exam question. Both of these policies cover two people, but the trigger for the payout is totally different. A joint life policy pays out when the first person dies, but a survivorship life policy, you'll also hear it called second to die, only pays out after the second person has passed away. This makes it a perfect tool for things like covering estate taxes that only come due after both partners are gone.
Whew, we have covered a ton of ground. So now let's lock it all in with a final rapid-fire review of the most critical things you need to take away for your test. Think of this as your personal exam cram sheet.
All right, let's burn these into your memory. Whole life, level premiums, guaranteed cash value. Term life, pure protection, no cash value. Simple. You see the word variable? I want you to immediately think policyholder bears the risk. You see indexed? That's growth tied to an index, but with the safety of caps and floors. What about universal life? We mentioned it before, and its key word is flexibility. Flexible premiums, flexible benefits. An annuity, it's all about creating income. And finally, survivorship life? Just remember, pays on the second death. You nail these down, you are in fantastic shape.
And that's our breakdown. You know, as you're studying, just remember that knowing these definitions is really only the first step. The real goal is to understand how each of these products works as a unique tool to help people build a wall of financial security around themselves. If you think about that while you prepare, you're going to do great on the exam. Good luck!